Commodities, taking a look at this past week in review. And let's just start out by taking a look, see where we closed at for the week. Starting out in corn, March corn closed a little over 6 cents up for the week at $3.63 in the March contract. Beans were a winner as well, up 13 cents on the week in the March contract at $8.79. Wheat lost a little bit on the week, down 4 3/4 on the wheat at $4.73 3/4 in the March contract. Moving over into the livestock markets, cattle had a rough week, limit down day today, but February cattle closed at $127.55 today. That's down over $5.32 on the week. Hogs had a better week. They were up $2.22. In the February contract, we closed at just a hair over $62. Taking a look at some of the outside markets, oil looks to close, still trading at this time, but down over $3 on the week and trading below $30 a barrel at this time. The Dow looks ugly as well, down currently down around 350 plus points. We were down over 500 at some point this week, but we're looking to close below 16,000 there as well. Looks to be the worst start for the stock market. First 2 weeks for the first year, poor start in a very long time. The dollar stays fairly steady on the week, a little bit stronger. Looks to close somewhere, still trading again at this time. Looks to close right around that 99 point level. One of the, if not the major factor this week, was our quarterly stocks report, and then working that into a balance sheet as far as a fundamental item to look at. And just take a look at some of the numbers here from the report. Let's start at the quarterly stocks report, and that's a snapshot of how much corn was in here at the beginning of the month. 11.2 billion bushels. That's dead on with last year's number at this time as well. Basically, we just took some corn that was in the east side of the Mississippi and planted over in the west side. So the west had better yields than the east did this year. Needless to say, same carry or same stock number, a little bit less than expected, but still a large number. When you take a look at it from the world perspective, we came in at 208.9 million metric ton. That's up from last year at 208.2 million metric tons. So we're seeing a small increase. The average guest was looking for a little bit larger world stocks number. With those stocks, how did we break it down in the balance sheet? Well, those stocks start out taking a look at that final crop production number. We did see our final yield drop in corn. We down around 168.4. That's down almost a bushel an acre from the November report. So we did see a smaller supply than expected, but we did offset that supply number by offsetting the demand side of the equation as well. We did see the feed and residual drop 10 million bushels. We've seen exports get whacked 50 million bushels. We left the ethanol demand alone. That all said and done gave us an ending stocks number of 1.8 billion bushels, and that's basically up about 17 million bushels from last month. So that ending stocks number didn't grow at all. Upon the release of the report, we did see some volatility. We ran it up to 363 plus in the March. We were unable to take that out the balance of the week on a very quiet trade following the end of the week. Taking a look at the stocks number over in soybeans, 2.714 billion bushels. That's up from last year's 2.528 billion bushels. So it's just under 200 million bushels more than last year at this time. Trade was looking for maybe a little bit bigger number there as well. World stocks were up as well, 79.3 billion metric ton versus 77.7 million metric ton last year at this time. A decrease in yield was the big item there. We're a little surprised by an acreage cut and yield cut. We cut acres, harvested acres, 600,000 acres, 0.3 of a bushel lower. They gave us a lower supply on the year. Taking a look at the demand side of the equation against that, we did cut exports 25 million bushels to help offset some of that. We left the crush alone, which is interesting. Crush is having a hard time, or it's projected to meet last year's crush totals, which right now with the margins in the crush plants suggesting that it's going to be tough to maintain that level of crush moving forward. And exports have been poor on meal as well as beans compared to the previous couple of years as well. But that's something to keep an eye on in following months to see if that crush number holds well. All said and done, we did lower our ending stocks, 25 million bushels down to 440 million from 465. I think that was a bullish factor in the trade. I think the trade was believing at the very minimum we were going to see a steady crush, if not a larger crush number, and the trade reacted to that with a positive push in the futures upon the release of that report, and again unable to follow through the balance of the week on that number as well. Interesting enough, though, too, we did see our wheat stocks come in much larger than anticipated, both from the United States perspective and from the world perspective. But we did see a bullish reaction to the trade on the release of those numbers, and that was due to the fact that winter wheat acres came in 3 million less than anticipated. The question moving forward now, those 3 million acres, what will they be planted to next spring? That'll be determined obviously in months ahead, but will be debated over the next several weeks, if not months. So taking a look at that, that's what the trade reacted to upon the release this week on Tuesday. And when you look at it from a big picture, there was more volatility in the grain trade than the previous few months report releases. But when you take a look at it from a historical perspective, or at least over the last 5-6 years, this January report can be one of the more influential reports, and we had a very tepid response to the release of those numbers. So we stayed very range bound upon the release of those numbers for the balance of the week. So as we take a look at what we need to, what factors from this point forward is going into spring, obviously acres are going to be a big discussion. South American weather is still going to be weighed upon the table. The last 2 weeks have been pretty ideal down there with the dry areas receiving rains and the wet areas not receiving the rains. So the talk of weather concerns have backed off in South America as well. And the other thing to be debated is the crush number in beans. NOPA came out with their monthly soybean crush number today. Came in at 157.7 million bushels. That's about right in line with what the trade expected. But that's the lowest number for December crush of the last 3 years. And we're going to need to project much stronger crush numbers seasonally as we go through the year compared to the last couple of years to maintain the current crush demand on the balance sheet. So those are some of the things to take a look at as far as the grains are concerned. Obviously, the managed money will have some say in here, still holding a record short position or close to a record short position for both corn, wheat, and beans. That might be the most bullish factor out there. They need to have some type of igniter to cause them, or a trigger to get them to cover their shorts. The report could have been one, but the balance of the week suggested that it isn't at this point. Currently, you got to take a look at some of these outside things going on as well. And with the crude trading down below $30 right now, the stock market falling out of bed, China economic concerns all weighing upon these outside markets, it certainly isn't a very bullish atmosphere in the markets. So I think what we're settling into until we see something come else out of the outfield bleacher somewhere is that we're probably going to be stuck in a range-bound trade here, and we're going to have to take advantage of basis opportunities when presented to us in the cash market. Taking a look at the livestock market, the ugly week for cattle futures, down on the week, down $3 on the futures today. Cash, not so much. Cash was steady to stronger on this week. We've seen 133, 134 trade in the south. In the meats, 208 to 212 in the corn belt. So didn't see much of a slide there as well. The choice cutout for most of the week did hold its strong gains we've seen over the last 2-3 weeks. Until today, we did see it slide a little bit. We were down $2.50 in the choice cutout. So the futures are anticipating a slower cash market in weeks to come, and they're anticipating that the boxes are going to back off as well. Yet to be determined, but it did certainly weigh upon the market today. There was gaps down below the market in the cattle charts. There is a gap above the market right now after today's gap down move above. So it'll make for a very interesting trade come Tuesday morning following this 3-day weekend due to Martin Luther King Day. Hog futures continuing their step ladder up over the last couple months. We're able to push out, make new highs this week. We stayed inside for the balance of the week after pushing out early in the week. Futures are continuing to trade at a premium. The cash catch up to the futures. That spread between the cash index and the futures right now is fairly wide. We still have still 3 weeks until that is settled upon. But some concerns on the hog country. You have the persistent rumors of PED out there. You have new strain of PRRS out there, talk weighing on helping support the market. Interesting too, we're hearing stories feeder pigs are doubling in price over the last couple weeks as well. Also today, there was announced that there may be bird flu in Indiana and a turkey flock out there. So all somewhat supported to the hog market, but I don't think the cattle and hog market can move in different directions very long. So that's something to keep an eye on. So if you have any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525.